Going to kick off this month's edition of the afterMATH. Thanks for joining. And we got a lot of ground to cover this morning, a lot of topics, so we'll dig right in. What's going on in the markets right now? To me, these are the two biggest factors that we're dealing with today, and it's weather and it's tariffs. Someone used the phrase this morning that tariffs right now are kind of like a blanket on top of the market. Maybe that's not a bad analogy. Weather continues to be a benign factor, I guess, for the market. Saw someone posted a picture this morning on X of dryland corn in Texas, and they said it looks like the I states. So it's just it looks like we're going to have a whopper this year, barring any big changes in anything. So let's start out with those two topics, and then we'll dig into some of the other stuff. When you look at weather right now, you don't have a whole lot of the country that we produce most of our crops that are in drought or in major drought, I should say. Do we still have the dry areas in Nebraska? Still have the dry areas across northern Illinois and into Michigan, northern Indiana, but those have continued to shrink a little bit over the last couple 3 weeks. When you look at percentage of land of each of the crops that's under drought, corn is down to 12% last week, cotton down to 3%. I don't remember a year where cotton was at 3%. Sorghum, all these numbers in single digits. Now, spring wheat is much better or much higher, and that's maybe causing a little bit of concern in the Minneapolis market. But winter wheat continues to be a fairly low number historically, too. So there's nothing here to get too excited about. You look at the change in the drought monitor over the last 4 weeks. Of course, we know what's going on in Texas, and thoughts and prayers with those folks. But you look up into the northern central plains, things have improved quite a bit. You look over the last 8 weeks, it's been a big improvement, especially in Kansas, Nebraska, the panhandle of Oklahoma, up into the Dakotas, so southern Minnesota. So, just about what you could ask for this year, we've kind of gotten as far as helpful rains and timely rains in much of the growing areas of the country. Calculated soil moisture, kind of a map here that resembles a little bit of the drought monitor, as far as our major growing areas. I guess this I-80 corridor across Illinois, Indiana, may be as dry as any. Of course, a lot of that sits in the city, so we're not too worried about it. When you look at the forecast over the next 7 days, though, this is from Empire Weather this morning, shows that area of the Midwest really going to catch some rains, the driest areas right now. So there's nothing for this market to hang its hat on right now. And if we look at some of the, you look at temperatures, going to be a little bit on the warm side, but not anything, not that big heat dome or anything like that we normally see in the middle of the country this time of the year. Now, looking at the 6 to 10, 8 to 14 day outlooks as of last night, we do see some areas, maybe warmer than normal, but not a lot that's drier than normal, just a little bit of a swath here in the southern plains. So all in all, for this time of the year, you can't help but ask for much better than this. And that's what we're getting right now. And I think that's going to continue to keep a lid on the markets. Long term, I don't know if there's anything here that's to get excited about. This is what the June, July, August map looked like back in March. Going into summer, we were looking at a wet or at a hot, dry Western Belt, Central Plains forecast. Now they've extended that out August, September, October. We'll see if it really happens when you get here. When you look at the latest ENSO outlook, we're in neutral conditions, well into fall. Could possibly, you could see La Nina perk its head up here late fall, winter, might be a situation where you see a winter drought this year. For all of those people that were talking about a drought this summer, maybe that thing is pushed back 5-6 months. So you could have a dry late period this year. Maybe not a bad time to take a crack at PRF coverage, something like that, if you're a livestock producer. But all in all, for the crops, the spring crops, it's kind of hard to get too excited. The tariff issue, we've sent letters out, the president has here last week, to numerous countries. You can see all of the rates here, the dates that those were announced, anywhere from the 7th to the 12th. The latest were Mexico and the EU at 30%. We had Brazil last week at 50%. We'll talk about that with cattle here in a little bit. I think that gave a little bit of a boost to the cattle market. Canada at 35%. We'll see. I think, you could certainly make a strong case that a lot of this is negotiation tactic, and we'll see what happens with the other countries between now and August 1st when those tariffs kick into place. But Brazil certainly have an impact on beef, potentially for imports, certainly coffee. If you're a coffee drinker, you might want to get ahead of this thing a little bit. But why are we doing it? I guess you can understand when you look at the trade imbalance, even in ag, you look at just ag itself, we're importing more than we've exported this year in 2024, I should say. So I think we're trying to even things up a little bit. We'll see what happens in some of these negotiations. Switching back over to the ag markets, here's a snapshot of where the hedge fund positions are overall in ag. Now, this isn't just crops. This takes into account the livestock as well. So you've got cattle, hogs plugged in here, plus coffee, cocoa, and all the big grains. And so as of right now, these funds are pretty darn close to even up. You can see we've had several times in the last year or so where they've been well short, gone long this last winter, now back to about even. But if you just look at the grains and oil seeds right now, we're short about 400,000 contracts. So that's being offset by length in the livestock markets, and consequently overall in ag, the picture is there's not much of a picture. But right now in the crop markets, we're about as short as we've been in a long time. Last year was the biggest short we'd ever had going into late summer. I don't know if we'll make a test of that or not. That remains to be seen. But looking at corn, we got a lot of numbers to look at here. I'll try to blow through some of this pretty quick. But yes, Friday's balance sheet, the big number that stuck out here was the export number, a record 2.75 billion bushels. And USDA took ending stocks down to 1340. That was partly offset with a drop in the feed demand. But 1.34 billion bushels is a pretty darn snug number. And so average farm price also dropped a nickel to 430. I've seen a lot of stuff on Twitter over the last couple of days that these numbers just don't jive. How can you have this tight of an ending stock number with this low of a price? Well, it's a futures market, right? And futures markets always base their price levels off of what they think's going to happen. And so if you look at the 25-26 balance sheets, USDA did take the acres down slightly, as we had back at the end of June, which took production down slightly. So stocks are down a little. They offset part of that again with a drop in the feed demand numbers, ending stocks at 1.66 billion bushels. I don't know if anybody believes that number at the moment. We'll dig into that here in just a second. Most people, I think the yield is going to end up being a little higher than what we're at now, and that stocks will be up a little bit as well. Average farm price was unchanged at $4.20. When you look at the export numbers, what's fascinating this year is that this record export has been seen without China. China, barely buying any corn from the United States this year, barely buying any from anybody, yet we're looking at a record for the 24-25 year. I think that's pretty remarkable, because 2 or 3 or 4 years ago, we said we had to have China if we're going to get this thing turned around. And now you've seen all these buyers, especially Mexico, buying a lot of corn this year. Japan's bought a lot of corn, Korea, et cetera. So they've all been very aggressive buyers. Going back to the June 30th acreage numbers, 95.2 million acres. The government dropped that just slightly, about 100,000 acres from where we were back in the March intentions. That's still the biggest we've been in many, many years. Looking at the states versus last year, which states are up and down, not too many states lower, Ohio, Kansas, and Oklahoma, but all the blue states are bigger. And you see, especially down through the Mid-South, you saw a big jump in corn acres. But even through the I states, you saw more corn acres getting planted this year. Records in both Dakotas. So we've flipped back from big beans last year, especially up in North Dakota, now flipping to bigger corn acres here this year. Now, what's going on with those acres? Well, as you look at the chart down at the bottom right, the good to excellent or the condition ratings right now are pretty darn good. It's either our second or third best year we've had in the last 10. You can see by state, this is a crop condition index. So this is a little different than the ratings, the good to excellent, but this is kind of bunching it all up. You can see which states are good and which ones are maybe not as good from last week. Illinois down through the Mississippi Valley did see a drop a week ago. We'll get the updated numbers out later today. But if you look compared to the 5-year average, the major corn producing states, Ohio's down, Michigan down, but just about everything through the middle of the country is higher. And so I think this is what's got the corn market on its heels right now, is that most people assume that 181 yield is going to be higher. It's not going to be lower than what USDA is currently using. And so as you look at ending stocks, one thing that's kind of fascinating, you look at what's happened the last you look at the last 5 years here. Susan does a good job of putting this chart together and showing, especially like in 2020, that was the year we saw the big growth in demand. But last year, we saw stocks drop throughout the year. And so here we are this year. We're starting out at or at 1.66 billion bushels. Will that number drop? Will we see demand exceed expectations? That's what happened in 2020, 21. That's what happened last year. My gut tells me you're not going to see a similar situation this year because we're already forecasting a very strong corn demand. And so I don't think it's going to be a surprise this year. I don't think you're going to see that drop that we've seen a couple of these years here recently. And so this is the stocks matrix. I love this tool to be able to look at the what ifs. And so if you start out with USDA's number at 1340 for this coming marketing year, and you use their demand number at 15,410, then we've got acres on the left-hand side, which USDA gave us what they call the July or the June planted acreage report number. Plug that into the July balance sheet. That was 95.203 million acres, harvested 91.1% of that. So then the numbers in the matrix are going to represent acres times yield. And so we got the yield at the top at 181. Using USDA's numbers today, that keeps your carry out somewhere in the mid 16. But what if we start to get up to some of these upper numbers? Pro Farmer in their letter a week ago mentioned potential 183.7. Somebody said market chatter in a letter the other day was 185. Arlen Suderman with StoneX said that the numbers today could indicate a yield of 186.9 based on the crop condition ratings. Someone else had put on Twitter the other day that the models point to, and they used a range of 183 to 189. So I put the 189 as the top end of this. So I don't know where we're going here, but if we're up here into the 183, 185, 186 range, now you're potentially talking about 2 billion bushels of corn carryover. And I think that that's what the market is currently trading. That's pretty simple. It's a futures market, and that's what the market is trading. Doesn't mean you have to agree with it. Doesn't mean you think it's right. Doesn't mean that's where it's going to end up. But that's where we're at, I think, here as of mid-July. Now, if weather changes, we get a hot, dry August, and you start sucking weight off, the test weight off the crop, something like that, sure, that number is going to come down. But as of today, that's why the market's where it's at. We won't have final acreage numbers. I think USDA can tweak those numbers in August based on what we've turned in for crop insurance here in July. So once these acreage numbers are turned in, the government will be able to get to those numbers. Who knows? Maybe we'll see a little bit of a decrease based on some wet conditions, especially in the Mid-South here this year. So we'll see some adjustments to this along the way, and we'll be able to update. So Karen Braun had asked this on Twitter the other day. I thought this was an interesting question. Which yield do you think we're trading right now? 183 to 185 was the highest, although you can see that was spread amongst all these other guesses as well. So I thought it was interesting to share that that's what the market is kind of talking about as of today. This was a chart. I've seen a couple of versions of this. I thought I'd share my own. Ignore the numbers on the far right for just a second. And this is what people think there's a disconnect. And I can't argue it right now, but most years when you see high stocks to usage, you see low price and vice versa. And so here's where the disconnect is. This current year, the 24-25 year, you've got stocks to usage down to 9.3%, yet the average farm price at now it's down to 430. But the trade is trading the futures. And the future is that we're going to see stocks to usage up maybe 11, maybe 12, maybe even 13%, depending on how high the yield goes. And that's why the average farm price is at 420. So that's the disconnect in the corn market. I know there's a lot of people with old crop corn out here wondering what's going on. Why are we not getting a rally? That's the reason. We're trading what we're expecting to happen. We're not trading what's already happened. And so the other side of this, if you want to be bullish, it still remains at the world level. And even though Brazil is raising a record crop as well, you look at world stocks to usage down to 18.5%, despite the fact that the U.S. crop is so good this year. And part of that has to do with just this great demand that we're seeing around the globe, not only for U.S. crops, but Brazil is increasing ethanol production each year right now, record ethanol production. And so if you take out the United States and look at the other three big exporters, Brazil, Argentina, and Ukraine, you're still looking at a 42-year low, even after the government came out and raised the Brazilian corn crop 2 million tons here on Friday. So again, if you're looking to want to be bullish, maybe you don't want to be a seller today. If you can figure out a way to sock this crop away, there may be an opportunity down the road. Maybe it's in the next year where, because of these tighter stocks, that we see some better opportunities at some point in time from a marketing perspective. Whoops, sorry about that. So looking at where the funds are at today, the funds, again, they're trading the now, what they see today. And right now they're trading 203,000 contracts short as of Friday's Commitment of Traders report. You can see last year at this time, they were much shorter, went to a record 383,000 contracts short. They haven't appeared to want to do that just yet. And again, maybe they're in the back of their minds thinking the same thing I've just talked about, that, this world stock situation is potentially bullish. And so, maybe they're satisfied with their net positions as of where we're at today. So here's the market. Again, we've talked about the disconnect, but the market's gone down as stocks remain pretty tight here on the old crop. There's a lot to digest on this chart. We made a new contract low early this morning on Monday morning as I'm recording this. Then the market traded higher into the close of the overnight session. And so I think that, you look at the stochastics down at 16, RSI in the 30s. Market is, I would call it, in cold condition right now, or at least very, very cool, probably oversold. But last year that didn't stop us, right? This year, maybe we don't have quite as much old crop corn that's going to get dumped on the market here in July and August. And maybe that's going to keep us from reaching way down into those lower numbers. I think 384, 385 was the low we had last year. Maybe we don't do that. If we're able to bounce, we got a lot of hurdles above us. First of all, the 9-day moving average at 420. Second of all, we got a chart gap here. I should have marked it on here, but the gap is up here in the upper 420s. 430 to 433 is where that gap sits. Then you've got this downtrend line, which seems to be a real booger right now. We've bumped against that numerous times, and we continue to really respect that downtrend line. So I think that's going to be in place probably until the expiration of the December contract. unless you see a very, very severe change in the weather in August. And again, I don't think we have that big surprise in demand this year. We're already forecasting huge export demand. So unless China has to come to the market and really blow our doors off, I just don't know what it's going to be that's going to take us above that trend line. So from a marketing perspective, you get back up to this gap, 430 or so, probably makes sense to be making some sales. 440-ish area probably makes sense to be making more sales. If you want to stay in the market, make a sale, buy an out of the money call. You can buy calls now when the market's cheap. If you want to make the sales later on, that's a possibility as well. So a lot of ways to go about it. You could use put options. We'll talk about options with the cattle guys here in a minute, but maybe put options are a way just to set floors under the market. We'll talk about ECO, but the people that bought ECO, you've got a put option with ECO right now that's holding, we started that base price at 470, 95% of that, we're well below that today. So even with good county yields, you could be looking at a payment with ECO. So those of you that bought ECO, I look at that as my price protection right now. And so I don't want to panic and be a seller today, given the current situation. I would want to sit tight if I can, especially on all my new crop. Old crop might be a different situation if you got to get rid of some old crop corn prior to harvest. Maybe you can own it, re-own it with a call option, something like that, if you want to stay in the market. Looking back at last year, thought it was pretty interesting to pull this chart out. And again, we talked about that a minute ago that, we had a lot more old crop corn hit the market. But last year we took December 25 corn down to a low at the late August at 385. And that was driven by sales of old crop corn last year. Here in July, we had taken the market down into the low fours, kind of like we are right now. And then we were able to solidify it and even get a little bit of a bounce. So we'll see what old crop corn does to this market. I think that's going to be the ultimate driver. Last year by this time, the funds had their record short position in place, but that next 40-cent downward spiral was all driven by old crop corn liquidation. So we'll see if that does happen and go forward. The 5-year outlook or the 5-year map here shows that we're kind of right on pace. We didn't get the June rally that we normally do, but the market is continuing to work lower. And over the last 5 years, we've actually made our low here in the beginning of August. I thought this was an interesting chart. If you look at since 2015, when the lows have been made in the corn market, August, we've had 2 years. September's been 4. That's more typical of having a harvest low. January was a little atypical, but we were coming off of some huge high prices that were made back in 2020. So that was kind of a little bit weird. A couple of these years, we made our lows after harvest as well. So we're coming into that window right now where you don't want to have to be a seller if you don't want to, if you can help it. That's why I think on new crop corn, I want to try to figure out a way to hold this crop off the market and hopefully look for some better marketing times ahead. Soybeans, looking at the report from Friday, a couple of things. The farm price at $10 here on the old crop was actually up about a nickel, I think. That's the only thing that was changed in old crop soybeans. On the new crop side, USDA adjusted its acres, adjusted production slightly, bumped crush to a record high. This is even a new record over last month's record, projected high for this coming year. So we're really cranking out the bean oil. Exports, though, are down 105 million bushels. We've talked about this for more than a year now, that this was the expectation as we go forward, that crush is going to grow, exports are going to drop. Ending stocks in this report went up 15 million bushels to 310. Average farm price fell down to $10.10. But when you look at the demand for beans, again, this is what we've been talking about for more than a year, that the crush continues to grow, exports continue to slide. As long as we have big South American crops, we would expect that to continue. The acres in the report on at the end of June, 83.4 million acres of beans planted this year. We're going to harvest nearly all but about 1 million of those. That's expected this year. When you look at the state by state changes, lot of red on the screen. A lot of people planted less beans this year, planted more corn. Last year was just the opposite. We had flipped and planted more beans. So as I expected we would see this year, we saw a rotation or a flip, about 3 million more corn, about 3 million less beans. And that's kind of what the government's saying as well. When you look at the conditions of beans, it's just pretty average right at the moment. I think we were 66% good to excellent. When you saw the change versus a week ago, and by the way, this afternoon we'll get updated numbers, but the condition index, you can see the red states were down, the green states in the West especially were up. But when you look at versus the 5-year average, a lot of states in the green right now. The states of concern, I guess, would be Illinois, Ohio, Michigan. But nonetheless, we got a lot of states that are in pretty good shape, a lot of bigger bean producing states so far in pretty good shape. So let's look at the matrix. What can happen in beans? Well, we're going to start the year at 350 million bushels. The government says we're going to use close to 4.4 billion bushels of beans next year. And the government said in July we planted 83.38 million acres. And so you can see across the matrix at 52.5 bushel yield, you're looking at it close to, the government said 310 million carryout. It doesn't take much of a drop from here in yield to where you start to dip pretty good. We've never grown a 52.5. So I think beans, unlike corn, I think, the corn crop is progressing very well, especially into the middle of July. Beans are usually a month later. And so I still think that the big bean month is August. We'll wait and see what weather looks like in the month of August. But I think beans have potential, for a rally based on weather a little bit more than corn does at the moment because of the later part of the growing season. So we'll see what happens. But, if you take down to, 52 bushel yield because of this strong demand, now you're looking at carry out maybe down to 250 million bushels. So let's wait and see what happens here. At the world level, it's still bearish. Things haven't really changed there. USDA's projections for the coming year still big. Still forecasting big production from the big three. When you look at Brazilian bean exports, they're running near record high, maybe not quite as big as last year's record. Part of that because they're exporting a lot of corn as well. They're taking advantage of the corn export market and shipping as much as they can get shipped here at the present time. And so you look at the funds. Funds were long 2 or 3 weeks ago. They've now moved to the short side of the market. A lot of this length had been driven by their length in bean oil. They are no longer, they've been liquidating a lot of that length. And so consequently taking their bean short position down as well. And so just a little bit on the short side of the market. You can see a year ago at this time, they were holding record short positions. Maybe not quite the case right now, partly because of what we've just talked about, plus partly because of this record bean oil production, this record crush that we're seeing here in the United States. And so if you look at the November contract, kind of all over the place, but here lately we've just broken it with this fund selling that's pushed them to the short side of the market. A week ago, following the 4th of July, we had a gap lower, and then the market has continued to drift lower since then. We took out this triple bottom last week. We've traded to a new low this morning overnight at $9.9825. But we've been able to push back above $10 here at the start of the day session today. And so maybe we can kind of hold that level. We'll see. Again, August weather is the key for bean production. And so we're still a ways away from getting to that level. Got a low back here sticking out at 971. You got this chart gap up here, which at about 1050, that's going to be, if the market decides to rally, or 1040 to 1045 or so, that's going to be a key level as far as resistance. Then you go up to 1075. That is the double top. So you got a lot of things that we mark here on this chart. As of this moment, the RSI at 40, stochastics in the teens, tell me the market is probably, more oversold than anything. So I don't want to be a seller today in November beans. If you get back up into this cluster of moving averages in the 1030s, and I decide I need to get some beans sold for new crop, probably not a bad place, especially as we get close to this chart gap. So that might be a level, and if I need to be a seller, need to catch up sell, probably be a level to take a look at. We'll look at ECO here in a minute. It's not providing quite the support as it is in corn because the market's not down percentage-wise that far from where the base price was set back in the spring. The seasonality in beans, you can see here that normally, by about the 1st of August, over the last few years has been our low. So we're kind of approaching that window right now. We'll wait and see what weather looks like here as we start the month of August. Looking at wheat, the balance sheet from Friday, there were a lot of changes in the numbers, but none were overly significant. The more significant was the drop in harvested acres was offset by an increase in yield. So production increased just 8 million bushels. Really, it was pretty much a ho-hum report for wheat on Friday. Acreage on winter wheat at 33.3 million, pretty flat versus last year. Harvested acres expected to be down. We'll see if that does happen. When you look at the state change versus a year ago, in planted acres, right across this southern mid-south tier was where we saw the biggest drop. North of the Ohio River saw an increase in winter wheat planted acres this year. When you look at spring wheat acres from the report at the end of June, 10 million acres, that dropped in favor of corn in the upper plains. And when you look at by state, North Dakota down 6.5%. You can go to the Northwest down as well. And then looking at the wheat ratings, winter wheat ratings score, again, kind of a mixed bag last week. When you look at the winter wheat condition, though, we jumped into this new year with a pretty good rate, or came into the year with a pretty good rating. Since then, we've seen about 3 straight weeks of dips here as we got into the month of July. So we've kind of taken the top off of that. I think that gave a little support to the wheat market. Overall, wheat yield 54.2 bushel per acre. On winter wheat, you look at states, you've got a couple of records here forecasted. Illinois at 87 bushel, Michigan at 89, Missouri at 76. So those would be some pretty big deals. Winter wheat production, 1.35 billion, basically unchanged from a year ago. Spring wheat condition, it's dropped 3 straight weeks. Spring wheat yield at 51.7, so down a little bit from last year. A couple of records in the North Dakota and Minnesota, offset by drops as we get out into Montana and Idaho. Spring wheat production down versus last year because of the lower acres. Look at overall at wheat exports. One of the bright spots is that we're up versus last year, and we're up versus the pace to reach USDA's forecast at the end of the year. Now, we're awfully early. We've just started the marketing year on July 1 for wheat, but it's been a good start to the year. And so anybody that's nervous about wheat business should feel a little bit better that we're seeing wheat business pick up. Now, U.S. wheat stocks are expected to jump this year, the highest we've been in several years. World wheat stocks continue to decline, especially in Russia. If you look at the Russian wheat situation, their wheat supply, the lowest since 21-22. And so that is giving a little bit of a boost, I think, to the United States. And we're seeing a few extra buyers that we normally don't see for this time of the year. So good news there for the wheat folks. The funds, though, still short, but they've bought back a bunch of it. Now they're only short 55,000 contracts of Chicago wheat. So that's a good sign there. The market hasn't really responded because I think we're offsetting some of their buying with some selling here at harvest time. But nonetheless, we've seen higher lows the last couple of times the market has dropped. We had a contract low middle of May. Market has had another low here at the end of June. We had another low again overnight. The market turned back higher again. As of the time we started the meeting, we were about unchanged. So we'll see if this 535 to 540 area can hold. You've got a cluster of moving averages here, just shy of right around 550. Then the 100-day, but more importantly, the 200-day moving average now down to 584. And I think that that's a pretty important level for this market. If I'm looking at a target, probably looking up at that 575, 580 level, that 200-day moving average. If we rally back to that level, probably be an opportunity to take advantage of a sale. Hard red winter wheat, similar. The funds bought back some of their short over the last few weeks as the conditions have dropped a little bit. That being said, we still did go down and test the contract low here at the end of last week, down to 516. It's held so far. It looks like a nice double bottom. We filled the little gap that we had left following the 4th of July. Here this morning, we're flirting with the 9-day moving average on Kansas City September wheat. I think we were back below it when the meeting started. So kind of like Chicago wheat, I look at the 200-day moving average line up around 587 as a target. Maybe 575 to 580 would be a place I'd want to put some offers in to start selling some of my wheat out of the field here for this year. And then finally, spring wheat funds have actually moved back to the long side of the market in spring wheat for the first time in a while. In fact, first time in over a year. And a lot of that, I think, has to do with a couple of things, conditions and lower acres. And so if you look at the market, it isn't really responding a lot yet because I do think we're seeing a little farmer selling. But again, we made our contract low in May. Since then, the funds have bought. You can see the impact of that buying that we've seen from the funds lately. I do think that the Minneapolis market's probably the strongest of the three. And can you get back up to the 650 area? If so, I think that would be a level I'd want to be making some new crop sales here for this year. And finally, in cotton, we did see several changes to the cotton balance sheet on Friday. We saw harvested acres for old crop. They do a lot of this jockeying around, and I can never understand why, but they lowered old crop acres, harvested acres, raised yield, kept the production therefore unchanged. But we did see an increase in exports, which was pretty phenomenal to me. We went from 11.5 to 11.8 million bales, took ending stocks down to 4.1 million bales. On the new crop side, again, we saw a jockeying of harvested acres and yield, which did raise production just a little bit, which took ending stocks up to 4.6 million bales. So nothing bullish out of this report at this point in time. The government's projecting, and I think rightfully so, that we're going to harvest a bigger chunk of our acres than we've seen in a long, long time. You see dryland acres doing very well so far this year, especially in Texas. And so that probably the indicator that we're looking at a higher production, even though we've had acres down over 1 million here this year. So all acres, this was a bearish surprise back on June the 30th when the government came out and put acres above 10 million. I think a lot of us were thinking 9.5 million-ish, something like that. So that was a bearish shock. You can see, though, versus last year, where the planted acres went down just about everywhere, but Kansas and Arizona saw lower cotton planted acres here this year. Condition numbers, so far the crop is doing well. It's not a record, but you look at the ratings, we've only had 3 years higher, 5 or 6 years lower. So we're in the upper tier. And I would anticipate that this is probably going to improve a little bit when we get the numbers out this afternoon. So looking at the matrix for cotton, the big surprise, again, the 10.12 million acres, and then you take a bigger chunk harvested, over 85% harvested, according to the government right now. They're estimating, carryout's going to be around 4.5 million bales. Yield is going to be the big factor here. If we harvest those acres, is yield going to be good? And if the dryland yields are good, now you're potentially looking at pushing, who knows, you can push ending stocks up to 5 million bales. And the government's already projecting a very good demand number next year at 14.2 million bales. So I don't think you're going to get help from the export side of things. I think we're going to be predominantly looking at yield here as we go forward. And I think that could be bearish if the weather continues as has been. And so the U.S. Stocks to usage expected to be similar to last year. I think that number could get a little bit bigger. At the world level, it's been pretty flat, looks like, over the last few years. So this I thought was pretty interesting when you look at why exports matter for cotton so much. Yeah, they do for everything, but when you look at cotton, 84% of our demand is from, our share of export markets. So this is what's really a big deal. And this is why we need to get a trade deal done. I think with China, that would give us a boost here in the cotton market. Cotton usually tends to follow the Dow Jones average when it doesn't have anything else to follow. and that's a sign of the economy. That's a sign of a little bit of world economics. But China's trade deal would really give this thing a boost. And until that happens, the funds seem to be happy staying on the short side of the market. Short 46,000 contracts of cotton right now. They know that the acres were bigger than expected. They know that yield and harvested acres right now are pretty good. So they're not wanting to get off the short side of the market. And until that happens, we're probably just going to continue to linger here in a sideways to lower pattern. You can see these moving averages, the 9, the 20, the 50, the 100 are all just gradually sloping a little bit lower right now. Kind of holding the market in place right in the middle from the recent low to the recent high. The biggest line on this chart is this blue 200-day moving average. That's continued to be the blanket on top of the cotton market. Now it's below 70 cents. If we're able to rally, I would probably want to make a sale up against that. And that would probably, our indicators would probably tell us to do the same thing if that were to happen. If we're down here lingering in the mid 60s, I probably want to sit on the sideline. RSI at 48, stochastics in the 20s, 30s, probably indicate a flat market right now. Switching over to give you a quick glance at the livestock market. The reason I want to is we've got record highs in cattle right now. You can see where the funds are at as of last Friday's report. Funds were buyers of feeders last week, sold a few hogs, sold a few cattle, but they're long. All three of those markets right now. The October live cattle market, not a record this morning so far. But did set a record last week, trading over $220. You can see that I've got cattle in the hot zone right now. We've got the RSI at 70. Stochastics have backed off a little bit, but still up around 80s to 90. And so I think this is a market that if there was ever a market made for put options, this is it. The idea of a put is it puts a floor under the market while it gives you potential to make money if the market goes higher. The best put option that you can buy is the LRP livestock insurance because it's subsidized by the federal government, and you can get a cheap put that way under your cattle. Doesn't mean that the market's not going to go higher. We've written a lot of LRP insurance over the last several months, even the last couple of years, and the market has continued to go higher, which is absolutely what you want it to do, right? You don't want the market to go down and be right on the put option. You want the market to keep going higher. So the put is there to protect, but if the market goes higher, take advantage and then sell the cash at a later time. Same with feeders. We've traded to a record high at the end of the week, over $324, back up a little bit here this morning. Stochastics, RSI indicate a very, very hot market right now. I would probably, a good time if you bought some new feeders recently, maybe you want to hedge those with some LRP insurance just to put a floor under this thing. The hogs have backed off of their high. They had set a new high as well back in June. They finally backed off, but you can see for at least a month, we had the RSI at 70 and stochastics in the 80s, 90s. This market was well overbought, finally did correct, and now we're kind of taking a deep breath. I think this 50-day moving average just under 90 cents probably ought to hold. If it doesn't, you've got good support down at 85 cents. Might be a little later that I'd want to put on coverage right now for hogs, but for the cattle, I would certainly want to put some protection on. So we've talked a lot about the grain side of this. I want to take a look at crop insurance. We'll also look at the government program side of the equation here this morning. When you look at the crop insurance, we are in the process of setting the harvest prices for winter wheat in the northern states at the moment. Southern states had theirs set at the end of June. We ended up down 9% on July wheat versus the base price. Kansas City July wheat was down 9% as well. What's that mean? Well, it means unless you had a 95% policy of some sort, you're probably going to have a yield loss as well in order to trigger a revenue loss. But price being down 9%, you would only have to, if you had 80% insurance, then you'd have to be down 11% on yield, in addition to the downside on price to start to trigger a loss. Very similar looking numbers here so far for the northern states. September Chicago wheat down about 9%, Kansas City running 11.6% down. So you'd probably have to have a bushel loss as well to trigger a revenue claim in those areas. I mentioned ECO a little bit ago, so I wanted to give you an update on where ECO looks like. So if you go out, pull our ECO indemnity worksheet and matrix off of the agent portal, you can look at a what if here. And I did a what if today for Champaign County. Over the weekend, I used Friday night's close, which is $4.12. Use that as the harvest price compared to the base price at $4.70. This top part of this worksheet is where we calculate the producer's coverage. And if he had a 9% band of coverage with ECO and his APH, you get to use that to determine your band's worth. Then 9% of 470 times 235, it gives you the expected crop value times 9%, gives you that value, that 9% band, $99.41. Then I went backwards and figured out what county yield could we have and still trigger a payment. And so plugging in the numbers, 246.6 bushel in Champaign County would be triggering a loss of $1 given that type of yield and given a 412 price today. So this is how I look at it from a put option standpoint. I think we're not going to have a 246.6. I would be shocked if Champaign County's yield was above that. So as long as we're below that and the price stays where it's at today, we're looking at getting some money from ECO. We know that these are both still moving targets and they're going to continue to move for quite a while. And so that's how we can use the matrix then. Knowing that we've got some support in the market today, at 412, I can look at the matrix and see, well, if we came out at 239.1, we're going to get $33 back. If we came with an average yield as expected at 27.7, we're already looking at $80 an acre. And so I do think that yields in most areas are probably going to be better than expected for the county at this point. So you might want to focus more on this top end, but you can also see then where prices would have to be or go to in order to trigger a loss. One thing you can do if you're working with this worksheet, maybe if I think yields are going to be all better, then I don't need to look at these lower numbers. Maybe I can change the percentage in the yellow bar. So maybe I go to this far left one up here and change it to 100% and do 2% increments all the way across here, or 3% increments to show that as long as we're better, this and the prices where they're at, here's what we're looking at for payments. So I can start to fine tune this worksheet as we get further into the growing season. For soybeans, I would actually have to have a yield loss slightly as of Friday night's close, not much, but just a little bit in order to trigger a little bit of a payment this year. And I can look at the matrix and say, okay, at 100%, at 1007, I don't quite get any money. If we go down below $10, we start to trigger some payments. So we're close to being at the money here, not quite there on soybeans. And we've seen that on the price chart, that how far we are below 470 in corn compared to, we're not that far below the 1054 on the soybeans. Finally, I want to switch to government programs a little bit. And I did a Thinking Cap video last week talking about some of the provisions of the One Big Beautiful Bill Act and how that's going to affect us in production agriculture. And so let's go back over that again. These were some of the highlights, the slide that I had in that chart, in that presentation last week from the One Big Beautiful Bill. So instead of having a separate farm bill this year like we've seen in the past, this year we had one big bill, and that included a farm bill. Here's all the things that are going to impact, or I think all the things that are going to impact us in production agriculture. Number one, USDA is raising the PLC reference prices, and we'll look at those numbers here in a minute. They raised the PLC effective reference percentage to 88% of the ARC benchmark price. In the past, it had been 85% of the ARC benchmark. So we'll show how that is impacted here in a minute. They raised the ARC county trigger to 90% from 86%. They've raised the Ark County band, the dollars, 12 to 12%. It used to be a 10% band, used to be 86 to 76. Now it's going to be 90 to 78. For 2025, I know you went in and signed up for a program back in March. That doesn't matter anymore. They're going to give you the higher of a PLC or an ARC payment for 2025. Since this is being implemented after that sign up, they're going to ignore what you did back in March. They're going to give you either or. Starting in 2026, you will have to make a decision again. Choose between PLC and ARC. They're going to be adding up to 30 million new base acres around the country. Farm Doc just had an article out this morning. I'll attach that with my email letter this afternoon. You can check it out and see. I'll show you the chart from it here in just a second, where those acres are anticipated to come from. They're going to increase the per entity limit to 155,000. So for a married couple, you each have an entity, that's going to be $310,000. The SCO trigger is going to go to 90%. It's going to match the Ark County trigger. So that's going to impact, I think, some of the top end policies like ECO, margin protection, MCO. Those are probably going to be 95 down to 90 in the future. We haven't seen that announced yet, but we anticipate that's going to happen. SCO subsidy is going to increase to 80% from 65. So the government is almost begging you to take SCO to get up to at least a 90% band of protection and an 80% subsidy. They're going to allow you to do Ark County with SCO. In the past, you had to do one or the other. So you're going to be able to look at, and the reason is, I think, is that they've decided that SCO is an annual coverage. It's looking at the price this year. Ark County uses a 5-year Olympic average price. So this allows you to have a mix in your risk management. You have a policy over here with this year's price. You can have this other program with the 5-year Olympic average price. You don't have to pick one or the other. And then finally, beginning farmer and rancher coverage, we used to be 5 years. That's going to 10. So for young producers that have been able to qualify for this, you're going to get an extra 5 years of discounts. And so that's going to be a nice deal for you as well. So I mentioned the prices a minute ago. I picked out a few crops. You can go find the table with all the crops. These are the bigger crops that we work with. These are going to be the new PLC statutory reference prices in the dark blue box. All of these numbers are bigger. Some gain quite a bit. The 88%, the effective reference price, is going to be based on the ARC benchmark price in a given year. And the ARC price is in this maroon box over here. These ARC prices are the 5-year Olympic averages. These are the same as we talked about back in the spring this year. Those haven't changed. The 5-year Olympic average on corn is still 503. Beans are still 1217. Wheat is still 672. What is going to change is this effective reference price, because that math is using 88% now. Back in the spring, we were using 85%. So the PLC's effective price for corn, I think it was 428 before. It's going to go up to 442. Beans are going to go up to 1071. You can see the math here. If the ARC benchmark, it'll use the higher of this effective price or the statutory reference price. So for crops like rice, cotton, peanuts, they're just going to stick with the PLC reference price. But some of the other crops at the top here are going to actually pick up PLC price this year because of the 88% using the ARC benchmark. I put in a column, the red column, which is 90% of the ARC, which is the ARC trigger. So if your county were to have an average crop, then a price below 453, 1095, 605 would start to trigger a loss. I know that most counties are probably looking at better than expected yields, but just wanted to try to compare apples to apples. These are the current yield price estimates, market year average estimates from USDA as of Friday. The marketing year starts September 1, goes through August 31st next year. We haven't even started the marketing year yet, but this is what USDA is currently forecasting in its balance sheet. 420 corn, 1010 beans. That dropped a little bit on beans. The rice number went up a little bit. Everything else was unchanged from last month. But if you look and compare this gray box to the lighter blue colored box, every one of these prices right now would be triggering a PLC payment. So as of today, for the 25 crop year, everybody listening to this, for every crop you have on this sheet, is going to expect to get a PLC payment. That PLC payment would be made in the fall of 26 after the marketing year ends on August 31st. That's assuming prices stay where they're at today. So this is another way that you've essentially been given a put option from the United States government. This is a much better deal than what it was going into this one big beautiful bill. So by raising those reference prices and raising this effective reference price, you're all in the money right now for PLC. So if the markets stay where they're at, you don't have a lot of downside risk on your base acres. Keep in mind that PLC and ARC pay on 85% of base acres. And they're going to pay on your payment yield. PLC is at the FSA office. So it's not going to be on all your bushels. It's not going to be on all your acres. It's on base acres and 85% of it. Several of you signed up for the ARC program. Now, we know for 25, you're going to get the higher of ARC or PLC. ARC is using this 503 benchmark. So it's a better number. Beans are a better number. And so depending on your county yield, some areas may be looking at better ARC payments potentially for 25 than maybe what you would for PLC. And if that's the case, then that's an even better deal. So we got a long way to go before we get to the end of the marketing year, but we're going to keep you updated on this as we go through because you're going to get the higher of. And I believe this impacts your marketing as well, because if I'm sitting here in the money on my PLC and I'm in the money on my ECO crop insurance, then maybe I can figure out a way to sit tight and not have to make any sales right now. I know that might limit a lot of us that have, space limitations, but it's at least something behind you. These payments don't hit the bank account anytime soon. These don't happen until October, November of 2026. So it's going to be a long time down the road, and that could be a hurdle for a lot of us as well. And maybe it's such a thing as you look at using the loan program then. If you've got the storage space on the farm and you don't want to make the sales anytime soon and you need cash here at the first of the year, maybe you're going to look at the loan program this year. That might be something to consider as well. And then I do have this one final column over here. This was the crop insurance price. This is what we use for ECO, 470. It's what made it look like an attractive program. Beans at 1054. So we'll continue to update all of these numbers throughout the year. I just wanted to share where we're at here with the new one big beautiful bill. And then we talked about base acres. USDA I mentioned that FarmDoc had a letter out today. This is a snapshot there. This is their added base acre indicator based on the formula that they're looking at by state. They think that some of these states, I think that had some broken ground or had a lot of cattle, had a lot of pasture ground that was put into cropland over the last several years, maybe 20, 30 years. Those are probably going to pick up the most acres. But you can see here going down the list, a lot of states expected to pick up a lot of acres here this year. One other thing on farm program stuff, I don't want to be an expert on this. I don't profess to be, but there was an announcement made here recently that about the new supplemental disaster relief program. A lot of farmers have been asking questions. I'm getting a lot of questions every day about it. You may have gotten an application in the mail. Stage one to applying for this program is you're going to get an application in the mail. If you received a crop insurance payment for the 23 or 24 year or NAP disaster assistance, you're going to get this letter in the mail asking you to fill out this application. You're going to have to put in what the reason for your loss was. Several of you in some areas will be able to put drought, flooding, wind, hurricane, whatever. There's going to be a lot of folks that got payments because of price, because of revenue. I'm not sure what to tell you to put. I would probably just put the word revenue and send it back. I believe that the government is not going to, I don't think you're going to be able to get a payment based on drought unless you were in a D2 drought county, I believe. And so if you're in a county that had decent yields, but just got payments because of the drop in the price, I'm going to guess that they're probably not going to give you a payment. But it doesn't hurt to fill out the application. They send it to you in the mail. I'd probably fill it out and send it back. You can put whatever you want as reason for loss. Certainly, if you did have a weather-related loss, that's what they're looking for. And so definitely put that in, send it back. Again, I don't think it hurts to send it back, regardless whether you did or didn't. But just know what I know, which isn't a lot, that if you didn't have a weather-related loss, then I'm going to guess you're probably not going to get the money, but I'd go ahead and send it in anyway. Let FSA sort it out. So that kind of wraps up our discussion this morning. We had a lot of topics to talk about, a lot of different things on all three parts of the triangle. What do we got coming up? Tomorrow's our deadline to turn in your acreage. Try to get it in. Hopefully you can get that done today or tomorrow, both at FSA as well as crop insurance. August 12th is our next USDA report. That'll start to get a little bit more important because USDA could make changes to the planted acreage numbers based on these acreage reports turned into FSA and crop insurance. B, we'll start to see some changes potentially in yield based on ear counts, based on pod counts. They'll already start to be doing stand counts, things of that nature. So could start to see some changes there. We'll talk all about it in the aftermath on the 13th, in addition to anything new that we know on government programs at that point in time. September 1 is Labor Day. Markets are closed, so we'll have a 3-day holiday weekend. We'll come back with our next USDA report on the 12th of September, which will certainly have updates on yields, because between the August and September reports are when we get all the different companies do their crop tours, the Pro Farmer Tour, et cetera. So all those happen in mid to late August. So we'll be looking at all of those impacts in the September crop reports. September 30th, we have a grain stocks report, which is our year-end stocks as of September 1. The government tells us what we had. It might be a surprise. Who knows? Sometimes we do get surprised because the government will accidentally count some new crop harvested grain in their old crop stocks numbers. So keep in mind that September report sometimes can be a little bit of a doozy. That's also going to be our deadline for crop insurance changes for winter wheat, for margin policies for corn, beans, wheat. Those will be all setting prices from August 15 to September 15. So we'll be doing that here in the next, less than a month. We'll start to do that as well. So a lot of things coming up to discuss. We'll talk about all of it here in the August report. So with that, thanks for joining me today. Hope you have a great month ahead. If you have any questions, might be a little late to send them in today, but shoot them at me, shoot me a text, email, whatever down the road. We'll be happy to answer those. Take care. We'll talk to you again soon.